Our classroom stock portfolio now has an annual return of 19.93%. The portfolio has broken the $2,000 level and is now worth $2,063.84 after 126 weeks. Hi, Professor Rex here. We are almost 2.5 years into our class project where we invest a total of only $12 per week and split it up to buy 10 different dividend-paying stocks. This week, our higher yielding stocks did well while tech stocks fell 2.3%. In fact, our high yield portfolio, which I discuss later in this video, increased its lead over our dividend growth portfolio, which is shown on this slide. For example, Best Buy, which has a yield of 4.6%, benefited both portfolios with an 18.6% gain this week, but it's a much larger position in our high yield portfolio than in our dividend growth portfolio, again, which is shown on this slide. If you're new to my channel, I teach college accounting and I often show my students how to use the accounting concepts that I teach to pick stocks because it grabs the attention of my students and gets them engaged. To show them accounting concepts in action, starting a little over 2 years ago, each Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 each month, into 10 dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. Also, viewers can use our progress as inspiration for their savings goals and to get ideas of company names that they can do their own research on. There are timestamp links in the description of the video in case you want to just jump to the list of stocks we bought this week or the list of our best performers or any other section of the video. In 2022, the year we started the portfolio, the market did not perform well, but because I do not believe in trying to time the market, we kept buying each week at what turned out to be great prices. Then in 2023, stocks took off. Currently, the portfolio's value is over $2,063. The portfolio's return has been 19.93% per year, which is higher than the S&P 500. Last year, the portfolio's return was 28.6%, which also beat the S&P 500. And in the preceding year, the portfolio once again beat the market. So why do we only invest in dividend-paying stocks in this portfolio? That's explained on the next slide. The first reason we stick with dividend-paying stocks is, according to a Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, average return has been much lower at 4.27%. The study is updated each year and was recently updated to include last year, so go check out the source link that I included at the bottom of the screen. Maybe more importantly, historically, dividend-paying stocks have less volatility than non-dividend-paying stocks. It's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks. And that's a good thing, of course. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom stock portfolio only invests in dividend-paying stocks that have increased their dividend recently. Another reason to own dividend-paying stocks is for the potential to generate up to $123,250 of tax-free income each year if you are married and filing separately. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses but grows over time. And if you're married and filing jointly, you can make up to $123,250 in qualified dividend income and pay zero federal tax on those dividends if you have no other income. This is perfect for retirees and something for the young people, young investors to shoot for. If you're single, that amount is $61,625. Those amounts often increase each year as the standard deduction increases and the tax brackets are adjusted. So how are those amounts calculated? First, you find the 0% tax bracket for long-term capital gain, and then add that to the standard deduction, which is found in IRS Publication 505. As you can see in 2024, the standard deviation increased, meaning that you can potentially earn even more tax-free income from qualified dividends. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $123,250 that a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why did we choose to invest $12.50 per week, which is essentially the same as $25 per paycheck? The next slide explains that. The main reason why we invest only $12.50 per week into the portfolio is because I wanted to show my accounting students that you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally invested $25 per paycheck into this portfolio, but found the process to be so fun that I split it up and now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. By the way, I also invest in these same stocks in my retirement portfolio and my taxable brokerage account. The research we discuss in class is the same research I use for myself. Another reason I started with a low investment amount each week was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assume the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invests an additional 35 cents each week for a total of $12.09 per week instead of $11.74. So for our classroom stock portfolio in year 2, we boosted the weekly investment by 82 cents for a total of $13.32 per week. In year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. A very popular exchange-traded fund that only invests in dividend stocks is the Schwab U.S. Dividend Equity ETF, ticker SCHD. So SCHD is a large holding in my personal accounts, so I've been tracking SCHD's performance closely with our classroom stock portfolio to see which one's doing better. As of today, our classroom stock portfolio's value is over $2,063. If we'd instead invested the same exact amounts into SCHD on the same days at the same time of day, the portfolio's value would only be $1,774, a difference of 16.2%. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our classroom stock portfolio. I also prefer our actively managed classroom stock portfolio strategy rather than SCHD's purely algorithmic approach where no one is overseeing the stock selection. SCHD has, at times, had large positions in stocks that I consider to be value traps, and that's not a good thing. This slide shows our best performing stocks in our dividend growth stock portfolio based on when they were initially purchased. With tech pulling back over 2% this week, jumping up the chart past Broadcom, KLA, Tencore, and Lam Research is investment bank Evercore with a total return of 151.2% in 20 months. The stock with the biggest move in a short time is still the boring cereal maker WK Kellogg, which has provided a total return of 67.3% in 6.4 months. It cooled off a bit this week. And in not making the list, not making the list, is Intuit, the maker of TurboTax and QuickBooks. It came in at 16 with a total return of 54.8%, followed by Microsoft, one of my favorite dividend growth stocks, in the 17th position, providing a total return of 54.4%. And remember that total return includes both the dividends the company has paid as well as the increase in the stock price. Now let's turn our attention to the strategy column, specifically the category called dividend growth stocks. Over 90% of our investments made in this portfolio were made in these stocks, which means they are high quality stocks with a great track record of increasing their dividend payouts to investors. The other 10% or so investments so far have been made in smaller, usually smaller, under the radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies, but studies show that they have historically beat the market averages by a significant amount. On this slide, the radar dividend payers are Crane Holdings, Repositrack, WK Kellogg, and Finia. Before we look at the 10 stocks we bought this week, here are the 10 stocks we bought a year ago along with their total returns, which of course includes dividends. Domino's Pizza is the best performer so far, providing a total return of 75.9%. I still own all the stocks except the stocks in yellow. Most of these stocks were purchased over multiple weeks, which is why many have appeared in recent videos. But this slide only refers to investments made a year ago. We sold Fidelity National Info Services because they cut their dividend. This particular purchase of Fidelity provided a total return of 30.8% in less than a year, despite the dividend cut. And we sold American Tower due to a dividend reduction, but it still gave us a 9.9% total return in less than a year. The average return of the 10 stocks we bought a year ago is 35.27%, despite 2 stocks not being held the full year. The annualized return of all 10 stocks is 36.8%. Obviously, our purchases won't continue this high rate of return, but it's a great start for this portfolio. Now let's look at the dividend growth stocks we bought this week. Here are my ratings for the top 13 dividend-paying stocks this past week. They are Comcast, MasterCard, Visa, Allegiant, Masco, Nike, Northrop Grumman, Cigna, Chevron, Papa John's, Skyworks, Lockheed Martin, and Evergy. We purchased the 10 stocks that are not in the yellow highlight. The stocks in yellow have already grown to be 4% or more of the portfolio, so we did not invest more in them this week because we want to build a more diversified, less risky portfolio. Remember, each week we buy 10 stocks, and since we are investing such a small amount each week, it means we are buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends into the same stock from which the dividend was paid. Instead, each week we are buying the 10 stocks as shown on this slide, and we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account as cash, and split the combined total amongst the 10 stocks that we are purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks that we are purchasing that week. Now, for the sake of convenience, there's nothing wrong with simply turning on the brokerage company's auto reinvest feature, but we think it's more ideal to reinvest in our top stocks each week. This table on this slide includes the company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. The most undervalued stocks this week appear to be Comcast, Allegiant, and Papa John's. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates they are likely to continue to raise dividends. Therefore, this is a dividend growth strategy. And the stocks with the highest yields this week are Chevron, Papa John's, and Evergy. On this slide, I want to show the components to my quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% of our purchases. The other 10% so far have been invested in those usually smaller, under-the-radar companies that have been started recently paying a dividend. Those under-the-radar dividend-paying stocks tend to be riskier because they are usually smaller companies, but studies have shown that they historically beat the market averages by a significant amount. But all the stocks we bought this week qualify as high quality and are dividend growth stocks, which means they have a long history of raising the dividends that they pay to their shareholders. Risk is the first quality component, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision-making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported earnings, also called profits. And finally, the last quality component is financial health. If you're looking for lower risk stocks, I would suggest looking at the utility company Evergy first, followed by Nike. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. The companies earning the highest financial health ratings this week are MasterCard and Visa. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and a higher yield are Comcast, Chevron, Skyworks, and Evergy. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it works. Companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth in those dividends. In our list, as you can see from the last grade called Dividend Growth Potential, the companies in the best position to increase their dividends substantially are Comcast, MasterCard, and Visa. The companies with the best combination of recent dividend increases and potential of future dividend increases are Comcast, MasterCard, Visa, and Masco. And this slide shows stocks in our portfolio that have chosen to split their stocks. Since we keep track of every individual purchase in Excel, it's important that we have this slide to remind us to go back and adjust the purchase price, shares held, and the dividends per share that we receive once a stock split has occurred. So NVIDIA will be splitting 10-to-1 on June 4th, and Lam Research, one of our best performers, will also split 10-to-1 on October the 2nd. Here's a look at the 10 stocks that make up the largest portion of the portfolio as of Sunday. Microsoft's time at the top was short-lived, as both American Express and Comcast surpassed it as the largest holdings in our portfolio. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock. But I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's return would likely be higher if we always invested in our top 10 stocks, regardless of the size of the stock's portfolio allocation, but that also creates a more concentrated and more volatile portfolio, and many investors cannot psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst time. Can't emphasize that enough for new investors. Our portfolio holdings are now at 95. That might seem like a large number of companies to keep track of, but the spreadsheet that we developed for tracking the companies make it obvious when to sell a company once we download company financial and accounting information into the spreadsheet, which we do at least weekly and doesn't take that much time. I've had several older students who are closer to retirement take my classes. They are more interested in stocks with higher dividend yields and have asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of 2023, we started investing $12.50 each week into stocks with higher dividend payouts. Currently, the portfolio's dividend yield is 4.37%. But the companies in it likely will not grow their dividends as much as the stocks in our dividend growth stock portfolio. Therefore, this portfolio would be more geared towards investors closer to retirement. The average investment in this portfolio has provided a total return of 13.67% with an average holding period of 140 days, which is an annualized return of 39.6% using Excel's rate function. I need to emphasize that this portfolio has been around for less than a year, and there's no way it can keep up an annualized return that high since stocks historically average anywhere from 9 to 10% per year. And as mentioned earlier, it's even outperformed our dividend growth stock portfolio over the same time, which kind of blows my mind. I'll be interested to see if that's going to continue. So while the portfolio has been around since August of last year, the average investment in the portfolio has been held for an average of 140 days. For example, the investments we bought last week have only been held for 7 days, so that brings down the average holding period. On the next slide, we'll look at the high-yield dividend-paying stocks we bought this week. One thing that's different about this higher yield strategy versus our dividend growth strategy on the previous slides is we only purchase 8 stocks, and we have 2 different strategies within this portfolio. Strategy 1 emphasizes a higher dividend yield over dividend growth. This is perfect for investors in retirement or getting close. Strategy 2 still emphasizes high dividend yield stocks, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. Because there are 2 different strategies, we have 4 stocks in strategy 1 and 4 stocks in strategy 2, giving us 2 rankings. So each week we take $12.50 and split it between the 8 stocks. So each stock gets a 1/8 weighting. Having two strategies within one portfolio also means that a stock could appear in both strategy 1 and strategy 2. If that's the case, instead of the stock getting a 1/8 weighting, they get 2/8 weighting, which is 1/4, equivalent to 25% of that week's investment. Both strategies still only invest in high quality stocks, meaning a quality rating of B- or better. The 4 high yield dividend stocks we bought this week while implementing strategy 1 are Chevron, Interpublic, Gilead, and Pfizer. The 4 high yield stocks we bought this week while implementing strategy 2 are Chevron, Papa John's, Evergy, and WEC Energy Group. This week's purchases have an average yield of 4.5%, with Pfizer coming at the highest with a 5.5% dividend yield. And here's a look at our ratings for competitive advantages, management, and financial health for these higher yield stocks. And on this slide, we can see that their grade for recent dividend growth and current yield, as well as recent dividend growth history. And in the last column, you can see their grades for dividend growth potential, which will be much lower in the stocks or than the stocks in our dividend growth portfolio, which consists of stocks with usually lower yields, but a greater potential for excellent future growth of those dividend payouts. So in the comments, let me know if you have any questions. Also, let me know if there's any other type of investing videos you would like to see. And finally, here are the places you can reach me: X, LinkedIn, beatthestockmarket.com, and of course, YouTube. We'll talk to you next week.